All right, now we are coming down the home stretch. This is the sixth and final hour of the course, and I'm actually looking at some of these camouflage situations and thinking it's time that I offered a refresher for people who have taken the course and who have perhaps forgotten the many uses to which we can put camouflage, the many types of trades that we should be looking for, because I have a feeling that a lot of traders who have taken the course are a bit rusty and maybe just despairing that the opportunities are not sufficient any longer. But I'm seeing so many ways that we can use camouflage um, that I want to bring a note of encouragement to the lives of those who have taken the course and perhaps their skills have lapsed. All right, so just before we leave this slide, again, everybody knows that we're going to chop out some sort of bottom here because this low has to be tested, but we have the ability to visualize that chop in a way that is not only meaningful but usable with an ABC pattern and its X entry point. And this is an A trade. You can appreciate the fact that as soon as it hit X, it never looked back. It just kept on going. And the signal itself, the setup is perfect. Single bar, single bar, single bar. Got past one external, two externals. It's lovely. Here is another beautiful pattern, beautiful for reasons that at this point you should be knowledgeable about, certainly aware of. Look at the impulse leg here, AB. In the context of all the chop that's occurred before it, this little rally, AB, is nothing special. It's nothing in particular, but to us it's very special. It's very usable because it did what we needed to do. Single bar A, single bar B, single bar C. We don't know about C yet, but it got past one internal and one external there. It didn't break out in any very noticeable way, so it's a lovely impulse leg in the sense that its power is well camouflaged. And of course, we see that reasoning vindicated, corroborated by the price action that occurred from the time that X was hit. X was actually hit on this bar, and it went up. We probably had a chance to get out at P. The high right there looks like it would have reached P of the pattern, and even if not, when it pulled back, it only pulled back about, well, maybe 0.618 of the way to C. It didn't take us back down to the limit there to test our nerves. It just pulled back somewhat. So it would be a B trade or perhaps a B minus trade. If we got out of P right there, then I would rate it maybe a B plus trade even. Nice opportunity in Goldman. You can see what happened here. It's sort of funny. It looks like the impulse leg is kind of even with these highs here, but when we actually measure it, we see that that high is a little bit past even that one right there. But again, visually, it's tricky enough that it works in our favor. By the time we're here and start pulling back a little bit, we don't really sense anything in a way of a breakout rally right there. It just seems to be more or less in the same league as these peaks here. But of course, if we come at it visually with a little more nuance, the nuance that we've been learning, we see a good impulse leg. Single bar A, single bar B, got past one internal, one external, and a second external. So it's pretty powerful. We better be ready with our buy stop once we've made a low that from which we rally just a bit toward a potential point X. Single bar C as well. It's just got a nice look about it. And relative to all of this stuff here, we're not exactly getting a dramatic breakout here, but we're getting enough of what we need in the way of an impulse leg that we've got a very promising trade there. All right, here's an interesting kind of retro-engineered idea that relates to camouflage. And that idea is, and this is maybe as subtle and subjective as any rule, not a rule really, I'll call it an idea. But the idea is that when you get a camouflage opportunity that is so beautiful and subtle that when it doesn't work, you're left thinking, geez, this thing had everything going for it. Why didn't it work? Well, the obvious thing to do is to do the opposite. If a perfect camouflage buying opportunity doesn't make you money, think about the possibility that maybe you should be shorted or think about shorting it. So the beautiful little impulse leg that I'm talking about here is right here, A, B. And it certainly has a lot of things going for it that we love. You know, it got past good, legit internal, good, legit internalish external, and maybe, I'm not sure about that one there, but it's an impulse leg. And it even pulls back in the way we like. It comes all the way back down almost to A, so that even Gartley 1, 2, 3 players who are looking for uptrends, they barely see it there because the pullback almost comes down to A where it wouldn't have been an uptrend at all. But since it didn't come down to A, we've really got just a lot of loveliness going on. And we even had a rebound from C that occurred quickly. It occurred on the same 1 minute bar to trigger us in at X. And yet the little pisher didn't even get to D. And if it had gotten to D, it wouldn't have even required a breakout above, some important high like this one. So all those things, you'd absolutely expect this thing to get you to D, and it didn't. The obvious reason is because it's just the downtrend is going to continue. The selling is there. It's too weak. So from this point of frustration, thinking why I didn't get to D, forget the frustration. Just get ready to take the very first downtrending ABC that you see, as subtle as it can possibly be, even on this 1 minute chart. You've got a couple of externals right there to play with. And but anyway, from the point where this thing failed to reach D, and it absolutely should have, it had everything going for it, from the point it starts breaking down, you want to look for the very first subtlest impulsive move you can find, for the first tradable ABC downtrend. All right, we're in the appendix. I did say that I would take all 40 years of my options trading knowledge and try to compress it into 3 or 4 minutes worth that you can use. Obviously, if we're buying and selling options in conjunction, if we're doing it at hidden pivot swing points, we're picking up a little bit of an edge. In fact, I wish I'd known this hidden pivot. I wish it had come to me when I was still working on the Pacific Exchange floor, because I'd be retired now if I could apply these principles, if I could have applied them back then. All right, so with options, one typical options trade we would do would be in this illustration of a Newmont chart. We see it going up to a crystal clear rally target of 60.90. So one way we might try to make money on that is to be buying put options when it hits that target. And I want to point out the time is your enemy when you buy put options. And if you think, well, I'll go out 2 or 3 months just to give this more time to work, you're absolutely dooming yourself to a loss, because the more time you give it, the more the trade's going to work against you. The price that you paid for that option is very well handicapped to cover the risk of the person that sold it to you. And it takes into account past volatility, and your only hope of making money is if something really crazy happens in the stock and it goes outside of its standard deviation bands. But otherwise, the puts are very knowledgeably priced, and are priced so that you can't make money on them. Trust me, I've had 40 years to observe that. All right, so when we think of buying options, I would say generally speaking, don't do it unless you think your position is going to be profitable in about 30 to 60 seconds. And that's what we're kind of looking for here. If we're buying puts when this stock hits 60.90, that's going to be a top, and we expect this thing to start down right away. It's going to hit the top, and the next tick is going to be down because the 60.90, according to this pattern, is as high as it can go. So I would say buy options that have at least maybe 2 weeks on them. Let's say you don't want to get too much tighter than that, but you don't have to go out more than 4 weeks or 6 weeks or 4 weeks on the option, especially now that they have weekly options. All right, so I used to teach stochastics and everything you all wanted to know about stochastics in 5 minutes or less, but I've cut that out. But I may give a demo on that one of these days. All right, so we want to to make money. We want to buy some puts when the stock hits that 60.90 target, and we want to buy. Let's say it's November of 2005. We want to buy the puts, the November expirations in 2 weeks, so we'll buy some of those. How much should we pay for them when it hits 60.90? Well, there's one way to calculate that. We would use, this is Larry McMillan's option calculator. And the only problem with using a calculator to get good theoretical values for options is you need 20 or 30 years of experience to know that the 37 is the number you plug in there. That's your volatility assumption, and it's really what drives the model. And in order to sort of come up with a good number, you really need to be a Zen master. There's a very simple way around that, fortunately, and it's simply this. In this case, I'm saying, about how much I've got the months wrong here as far as where things are happening on the chart, but I'm essentially setting up the model to give me the price, the fair value, the theoretical value of a March monthly expiration 60 strike put with the stock at 60.90 at our target. So it says 1.96. As I said, there's a much easier way to derive the number, and it'll be even more accurate than this. And it's simply this. As the stock moves up to that 60 point, as it gets up to 59.90, 60.10, 60.20, go to your options screen and watch the bid and the offer for those March 60 puts that you intend to buy. And trust me, if you do that for just 15 minutes, if you follow the bid and ask spread religiously, diligently for 15 or 20 minutes, you'll be an expert on that put series. You'll know almost exactly how much they should be trading for if the stock rallies another 30 or 40 cents. So that's how you get around all the having to needing 50 years of 33 decades of experience just to use an option calculator. All right, the selection of subtleties is part of the packet that you will have received in the mail, and I had originally intended this selection, these charts, as a kind of postgraduate course. And over time, the Wednesday tutorial sessions, which we do in live in real time, supplanted the master's degree, the graduate studies course. So I never really gave these charts as a course, but they originated in the formative days of my partnership with John Boudiette and Steve Hauk. We have a small trading company called Bluefin, and the affinity between us was that these guys had both taken the course that I taught. I used to teach it not online but on location. It just got to be too expensive a way to do business. I lost a lot of money giving the webinar in Sydney, Australia, and over time I just migrated it to the web. So when John and Steve and I coalesced, we decided we should spend a month together just kind of looking at charts and talking about them, just so that we knew that we were all on the same page. And this selection of subtleties, these charts, represent price action, chart action, about which there was at least a mild disagreement. So these are charts that we all looked at, and we said, well, there's something going on here that we better really get down. And just as I suggested with a couple of those slides that you look at all of the text and try to visualize what the rules themselves mean, I want you to do the same with the selection of subtleties, because at this point you know enough to look at any one of these charts and to understand exactly what is being said about them. So if you read the explanations, the annotations, and try to retroactively put together the thought, it's going to bring you more learning, I think, than if I were teaching them at you. So it'll give you a chance to reason out that fact or idea that the chart is intended to demonstrate. Armistead wasn't here yesterday for my explanation of sausage, but I just want to say that sausage involves, let's see if I can find good sausage here. It's where you have a point B high or low, where if you look to the left, there's some prior peak or low that it does not get past. So you've got a nice rally, but it just fails to get past some high by a little bit. And in my way of looking at it, when you run an ABC pattern with the B that is expressed that way, a B that almost made it past some prior high but didn't, the pattern itself is less trustworthy. I'm not quite as confident about it. And my partner said, nah, if we got a B that gets past a couple highs but not some obvious one, it doesn't matter. It gives you equally good results. And they basically said, look, we'll trade it as we see fit. Just don't watch. You don't want to see us do these trades if you have this idea that the point B doesn't work as well. So this recalls Bismarck's statement about you don't want to watch two things being made: laws and sausage. And my partners were saying, just stay out of it. Everything will work just fine if you don't look. All right, so that is your selection of subtleties. And again, I would suggest that you look through them in a way that brings you to them with your trying to figure out exactly what's going on, because the figuring out will kind of, let's consider it mental calisthenics. All right, so we've got a pretty good time here for TradeStation. I usually try to shoot for at least a half hour on TradeStation charts, but we'll get a little bit more than that today, and that's good because I wanted you to see exactly how the learning process is enhanced when you're considering these hidden pivot ideas in a speculative way, when you're looking at charts where you don't know how things played out, as you typically will when you're looking at PowerPoint slides of charts. All right, so let me first ask: are there any questions? Are there any slides that we've seen that you would like me to revisit before I close up PowerPoint? All right, go ahead, Suresh. Let me just give me a number there, and we'll take a look at your chart. And I assume that it's not no slides, but you have a question. All right, let's wait till we get on I'm going to shut down the PowerPoint here, and let's see, we'll close it up, and I'm going to bring up TradeStation, which is actually live. It's switched on, so we're seeing real things happening in real time. And I'll give you your option here, Suresh. I'll for sure answer your question at the end of the hour. If you think there's some advantage in asking it now, go right ahead. But in fact, because we're on these charts, it's not a bad place to start to ask you if there are any questions you might have. Maybe you were looking at the E-mini S&Ps today, and you're wondering, what's tradable, how would we trade it, or whatever. So let me suggest that we begin this TradeStation part of the lesson with the questions from you. While you're formulating a question, I can get things rolling here by just showing you what I might be looking for in the E-mini S&Ps. And there's something that is so radically clear here, it's absolutely unmistakable. So if you're looking at it and thinking, well, yeah, it is, then we're on the same page. But I'll pose this as a question. What do you see going on here that is of such value and clarity that it absolutely can't fail? All right, and you can take a shot at that if you want me to. I'm going to unmute you there, Suresh, and you can take a try verbally. All right, so I've unmuted you. What do you see going on here that you should be in love with? All right, I don't know whether you. Actually, there's. I hear you. So.
One is. What? Yeah. I'm just trying to read the chart. One of the things that I like is the 1-off A at April 15th. We have 1-off.
All right, you're on the right track. The first thing you like about this is a 1-off A right there.
Correct. And it's in the uptrend.
And from there, you can see there's only 2 places for BC, and you probably sense even now that the first D has already been exceeded. I'm going to lay the lines on this pattern here. Oh, all right. Well, actually, this is a surprise to me. I don't know why I wasn't looking at this before, but my God, this is. I hadn't even realized this. We're exactly at that high. And I don't know. I mean, the high was predictable from here. When we first triggered X at 1862.25 back on April 28th, or 20, we would have predicted that D high, and I didn't realize it today.
And it hit that high today.
Were you aware of this pattern?
Not the pattern, but I was having a 1917-25D on today's pattern. It's a pattern within pattern. All right. But it had the same D.
All right. You know what? I'm just realizing that all that you're saying, I'm hearing it in my earpiece, but the Camtasia recorder that I use is too stupid to hear you. We're in a go-to room. I hear you because I've got a USB ear set plugged into my computer, but the Camtasia recorder hears things plugged into my computer, but it doesn't hear a virtual room. So I'm going to have to sort of throttle back our discussion because it's not being recorded. But I basically asked you guys for something that's gorgeous on this chart. And what I saw initially, what was on my mind before I realized something far more startling, was this pattern right here. Which gives plenty of running room. You know, we've got room to rally up to 1949.25. And I want to double check those price points because the pattern looks good enough to me that it should be able to deliver a top within a single point. And we can justify everything from there to there as being a straight line AB because we did get this last little segment that refreshed the bullish impulsiveness. With this last little segment, got past yet another high right there. So it's justified for that reason to extend the impulse leg. All right, and one of the key points that I've hammered is this idea that we look for confirmation of the pattern itself in the price action at P. And in this case, it is somewhat, it's there. I think we're getting a bit of a hidden pivot effect. I'm going to stretch this chart a little vertically so we get a better sense here. And if I were to ask the question, what do we get? Is there something going on at P? Well, the action from not today but yesterday it's sort of P-ish. We had a rally, we got above it, but we pulled back pretty wickedly to P right there, and it's an exact hit. The actual P is at 1904 50, we round it off, or we can round it, well, either up or down, but this pullback that occurred yesterday came right back down to P. It touched it, and from there, we had a nice rally for the remainder of yesterday and into today. So I'd say we have a P effect there. The stall, when it first hit P on the way up, is not particularly pronounced or distinctive. It did hit it, pull back, and then it made it through the next day. So I would say the jury's out on whether we've got enough of a midpoint effect here to say, yes, this pattern is absolutely the one. But putting it aside, we've got something that we need to reckon with more immediately that has consequences for that are already lapsed. That being, I should send everybody home short today. It's fascinating to me that this thing is the way it is. So, and what I'm going to do, I'm going to remeasure this pattern because I'm going to remeasure the pattern. The reason being, the pattern is so absolutely gorgeous that I want to see this thing get hit within 2 ticks. And we were above that today. The target is 1916.75. We had an actual high of 1918. Someone would quibble with me if they'd say, Rick, come on, you're within 1.25 points of the target you would have predicted. But just the same, I want to make absolutely sure that I'm going to double check myself to make sure that I've got the highs and lows properly located to allow TradeStation to draw that target. All right, so I put an A down there, and I'm putting a B right here, and a C down there, and it gave me, well, I think we're 2 ticks away on this. I want to get as absolutely close as I can. All right, so we've got a target at 1917.25, and now our high is only 3 ticks above that. So that is very much within the range of we got a perfect short up there. It overshot it by 3 ticks, but certainly we should allow for 3 ticks. It's perfect enough. It's not a dead center bullseye, but it's somewhere in the middle of the bullseye area. All right, so it's hard really. You don't know. It's really a coin toss trying to anticipate the next day's opening. And so I really hate the type of trade where even with something as fabulous as what we see here, I still hesitate to take them home short overnight. By that same reckoning, I'm a little nervous about the jumping on Apple when it was in full dudgeon today in the middle of a fabulous squeeze. And I guess I've been around the markets for long enough to know that when you come to the end of the day and you think, God, this thing looks great, look at it go, you just know it's going to turn to caca the next day. So I should have recognized that, and this would have reinforced that thought. So, but all things considered, bottom line, I should have advised at least a small speculative position overnight, just so we had a horse in the race. Because even if we take a little kind of out of the money call in the diamonds, let's say, or something like that, we don't really have to stick our necks out by shorting a futures contract. But if we're getting this major top here in the E-mini S&Ps, it'll be the same thing in the Dow. The Dow will open lower. So if we get, and because this pattern has been a month and a half playing out, and because it's the formation of it, the rudiments of it are so clear and so lovely that we should have faith in it. Well, we really had nothing to lose by buying a little out of the money put in the diamonds simply to have a horse in the race. So I regret that I missed the opportunity to do that. And you can see, though, that there are hazards to sort of actualizing what you know using options, because as we just discerned, our entry point was here. We were told to get long right back here on April, whatever it was, 28th or so. And there's no way, we're right, it eventually got to the target that we predicted, but there's no way we could have held any option and made money on this thing, because it's taken a full month for this thing to grind out the CD leg to the target. So it's interesting. I just wish I would have. This would have tempered my enthusiasm for Apple, and it would have probably brought me to speculate in just some mild way, not really to make money, but just to make the point. Hey, look, we nailed it. So anyway, it's a beautiful opportunity right here. I would say that if we noodle around tomorrow on the opening, I would still take the shot. I would still, it, it's worth doing it tomorrow. Mr. Market being Mr. Market, you almost expect things to open either on a gap down, or I'd be a little bit confused if it opened on a gap higher and took it above 1920 right away, because that would be enough of an overshoot of the D target that I'd start thinking, well, the chopped liver theory comes into play. The chopped liver theory is that this 1917 and a quarter target, it's not chopped liver. I mean, it's really there. We did our calculations. It's beautiful. We should depend on it. And if the E-mini just kind of blows through it, then we should not infer that we made a mistake or that the hidden pivot method doesn't work or whatever. We should say simply, this rally is really powerful. It blew right through an absolutely crucial hidden pivot, and so if you're thinking that way, the question becomes how much do we have to exceed the D target to consider the target blown, to consider it as having been exceeded in a way that pretends more upside to that higher target that comes from using this here as a B and that as a C. And the answer, I like this pattern enough that I'm willing to consider the D target compromised, blasted apart, with as little movement, let's say, as 19, 20, 21, 22. And that would make me hesitant to do the short, and I don't know. We'll have to see how it opens tomorrow, but it's really it's about as interesting as things get from a hidden pivot perspective. There's just a lot of things that become our immediate concern with what's going on here. So if we were trading at night and thinking, and then meanwhile, I am sort of going on and on here, and I would like either or both of you to formulate questions by way of a text. As I said, I can't get my recorder to hear you guys when you ask the question. So put the question in the form of a text, a sentence or two, and I will answer it. But I don't want to do all the talking here. I would rather come to things that interest you, that you may have pondered today or earlier, that were a little puzzling. So, all right, to keep me talking until you guys come up with a question, I'm going to make myself a nighttime trader, and I'm going to think, how do I get short it or long it, or how do I get to the point where I can see things happening on the chart that give me a little bit of a handle on what might happen tomorrow at the opening bell. So I know the big picture now. I can go right down to the 1 minute chart, because I already know what the big picture says. It says possible top right up here. And all right, so let me go down to we'll go down to the 3 minute chart just so we don't get shocked here. And if you went to bed with that assumption that I've made here, that we're at a potentially major top, you would be looking for an opportunity to get short overnight. And the first place we see gorgeous here is right here, A, single bar B, single bar C, got past internal and external. So you had an absolute shorting opportunity right there at X. And just to get the lay of the land here so we know where this is going, we've got A, B, C. So this target is pretty reliable. Well, let me get rid of the big lines there because we already know. All right, so we're looking at a little pattern here, and I'm not sure why we've got three lows here, a single tick off where I predicted it. The pattern is nice enough that we should have had an exact hit. I don't want to stretch it too far and say, hey, look, it's pretty bullish that this thing didn't get all the way to its D target. But it's curious. The pattern is so perfect that I wouldn't have hesitated to tell you it's going exactly to 1914 and a quarter. But just as long as you know the reasons why, I'm kind of in love with it, because single bar B, single bar C got past internal and real honest to God external, and even another one there. So to have gotten past these two externals, it's kind of a strong CD leg. It's interesting. And you might even say this is the very first hint that we're getting that big target D that we hit is bearing fruit, that this is the first reversal. And one thing that I want you to appreciate is that the hidden pivot method can give you the ability, the wherewithal, to identify a really important top, but it can't necessarily tell you that it is the top, that this is the end of the bull market. So we can't quite bring it that far along, speculatively speaking. However, the one thing that you can appreciate at this point is that every bear market begins with a tiny little ABCD downtrend on the 1 minute chart. And so even though we don't know that this will be the very top of the bull market, these bars right here, you can see where it's possible for us to get short from within a few ticks of that top. Again, without even knowing that we've shorted the mother of all tops. All right, so in that sense, if we keep moving down here and we break below 1914 and a quarter, it would be just one more small piece of very subtle evidence that something interesting is going on here, that maybe we do have a really important top, because in rallies that are supposed to continue, we shouldn't see corrective ABCDs like this one here that exceed even their P, let alone their D targets. So this is really pretty cool what we're seeing here. And I guess I'm going to have to put this out as a tout tonight, or at least warn the troops, because it's fascinating. And one thing I particularly enjoy about doing the Wednesday sessions and doing these, even doing the webinar, I see tradable stuff that I wasn't even thinking about. You might say that I'm a little bit jaded about just watching the E-mini S&P so closely, but I can't believe that I missed that 1917 and a quarter target. I'm thinking, how the heck did you do that? So you guys can thank yourselves that I'm here trying to bring out some teaching examples, and I kind of stumbled into a potential gold mine. All right, so let me go to your questions here. Armistead mentions he's disappointed that he missed this one, whatever that is, but I need to get TradeStation to import more data, as mine only goes to April 22nd. Well, you should be able to get it to do that in 15 minutes. Just do go into your file manager and do update data, or whatever it is. Suresh questions, so are you saying that because the price went past 1917 and a quarter by a couple of ticks, the pattern could have been breached? No. I'm basically saying, considering this is a 6-week pattern, a 2-tick overshoot I can live with that. I'm going to consider the target as having been reached, not on a dead center bullseye as in the Robin Hood story, where Robin Hood literally splits the arrow. The one arrow occupies the dead center of the bullseye, and Robin Hood's arrow splits that arrow. So I'm not I'm not at that level of expectation for our 19.17 and a quarter target, but to say that it missed by 2 ticks is really to say that that the arrow came just alongside of the 2 tips touch as they embed themselves in straw. All right, so I've answered that question. Next question: is this method applicable in currency futures as well? Well, certainly it is. I've as much as promised you that the same ideas that we're using here are applicable to all trading vehicles in all times. Now, I'm not going to tell you that it's just as easy to use hidden pivot patterns to trade wheat as it is to trade IBM. I look at wheat and soybeans in particular as two trading vehicles that are they're so ornery that they'll just piss you off. The thing is, they do what they're supposed to do. They reach the target, but they get there in a way that's preposterous. They'll gap through the X entry point one morning, and you'll miss that. And their behavior is so obnoxious that I just look for easier fish to catch. And I attribute that to the fact that the wheat and the bean traders, some of these guys that have been in the game since long before index futures even existed, they really know the game. They're people you would not want to sit down with at a poker table. And they're so good that in their game of second and third and fourth guessing each other, the evasive maneuvers taken by the underlying trading vehicle to keep them from making easy money, the evasive maneuvers are so stunning, so absolutely breathtaking that even using your ABCD targets and getting it right, you're still not necessarily going to be making easy money. So I have a target out. I actually have a trade. Let me take a look at the tout here. I think it was in the euro. So let's see where it is. Oh, the Swiss franc. All right, so the Swiss franc, here's the actual target, and we'll come back to this. It's a 240-minute, and I really like the impulse leg here. It goes so far and it's so sharp without an upward correction that we have absolute trust in that impulse leg. It's a good one. Single bar, got past all kinds of prior lows. And it went on to make a good, clean single bar C. So we've got to be loving the 1.1095p midpoint as a place to go buy it. So let's actually take a look. We're looking at Swiss franc June 240-minute chart. So let's take a look. All right, how do I get rid of that? Swiss franc 240, and I'll put up TradeStation again, and we've got let's see, 3 minutes. So I'll create a 240-minute chart, and we're getting to look at the same pattern. Let me squeeze it a little bit so I can fit in all of my notations. All right, we'll open it a little bit. Let's see, a little bit more, just so we get some verticality. All right, so let me run the same pattern here. We've got an A and a B. Let me see, make sure I got that right. And a C. All right, so we're noodling around here, and I'm not going to tell you, I'm not going to guarantee you, Suresh, that if you're trading currencies and you buy this target, you're going to pay for the course. But I have to say, they're going to be, this is a pretty good opportunity to do that. I have, because of the prettiness of our single bar A, Bs, and Cs, the absolute authority and legitimacy of the impulse leg, and the fact that P is kind of in the middle of nowhere, I'm loving that P. And I love it enough also that it's really a short till it gets there. I mean, we've got another 145. We've got another 50 points of downside, another $600 of profit just getting short to the target. So that's a little harder. I've as much as told you that it's usually going to be, almost always going to be harder to take the trade that's going with the trend than one that goes against the trend. Because by definition, going with the trend means doing what everybody else wants to do, what they're all aware of. We've got this downtrend and everybody's trying to get short. Very few people know to be in down here buying at 1.1095. But this is almost so nice that I want to say forget about camouflage, because sometimes a camouflage strategy will deny us a trading opportunity. And I'm seeing that more and more in the E-mini S&Ps, because we get the move down to P, but the first bounce from it is so, we get a really precipitous move down to P. The last little gasp of it is so steep that it doesn't leave any little externals that we can use when it turns around and starts to rally. And so what happens is we hit P in the E-mini S&Ps, and the initial rally off it is so fierce that it's already up here before we get a little BC pullback to allow us to get in. And by that point, the rally is so big that we're afraid we're going to have too much company if we try to enter. So I see that much too often anymore in the E-mini S&Ps. But Swiss franc is a little less picked over. I don't purport to tell you that we're just trading against a bunch of rubes. In fact, we're trading against some smart guys with very powerful computers and all that. But I have to tell you, and you should be here in about 6 weeks at this point, you should be able to say, I don't care if you lock 50 quants in a room and you give them supercomputers, I can beat their brains in every time. I'm going to tell you that. I'm going to say that we're already good enough that we can outtrade the smartest machines in the world. And it's only a few of those machines that can even guess that we're going to get a turn from 1.1095. So I hope that in just this one little teaching example that I hope you actualize it, because I think there's potential here for you to be one more guy who comes in the chat room and says, hey, I paid for the course with the first trade that I did. And I would encourage you to go into the chat room and say magnificent things about this course. I'm half joking, but really it helps when other people get the idea that the course really has some valuable things to offer. So I want to make them literally valuable to you, literally, by pointing out this beautiful target. I don't know whether you read too deeply into the tout that I've got out there. Sometimes the tout's a dead zone. I put it out there, and that absolutely ensures that nobody will see it or read it. At least the chat room has become that dead. All right, so you did read it, and let me ask you, do you have the intention of trading this P midpoint? And I like the Swissy because it's kind of a dead zone, because everybody thinks, the euro rules the roost, and the Swissy is just a remnant currency. The Swissy is interesting for a couple reasons. Number one, a number of years back, the Swiss decided that if their exports were to remain viable, that they were going to have to beat the crap out of the Swiss franc. And I was skeptical initially. You think, well, the Swiss franc has the best solid history of all currencies of being the real deal. The Swiss don't screw around. They've always liked a strong currency. But when push comes to shove and they're trying to sell Rolexes and very precision machinery, then the labor component becomes so expensive that Switzerland's exports are about to go down to the drain because their currency is getting priced out of hand. So the Swiss franc trading up around 160, they said, we're going to beat this thing down. And although I doubted their resolve initially, boy, did they ever beat it down, almost to par with the dollar. If you traveled in the 60s, that's no great shakes, because you can remember being able to buy 4 Swiss francs for a dollar. But still, relative to what's happened in more recent years, beating the Swiss franc down to a dollar was quite a feat. But it showed that the central bank, with limited exposure outside of Switzerland, can make the Swiss franc unattractive enough that they beat it down to par with the dollar. So I'm glad to hear that you're interested in this trade, and I'm not sure where I'm going to be when this hits 1.1095, but let me know how you do with it. As I mentioned, it may not be. I don't want to give this thing up with the camouflage tactic that gets the turn. We see the turn occur where we expect it, but the initial bounce from that number is so fierce that we miss it. So I would just as soon bottom fish there with the tight stop loss. Risk maybe. I don't want to get it too tight because it looks so beautiful. I don't want to get stopped out of it. So I don't know. I'm thinking maybe 10 ticks. Uh, a 10 ticks, $125. So, all right. So, what other questions do we have here? Armistead, you've been very quiet tonight. I'm hoping that you have something that you might want to ask before we uh, uh, call an end to the session. We've got about 9 more minutes. I'm going to take up the last 2 or 3 of those minutes with a closing statement. But all right, another question from Suresh: should I enter on the dot or should I enter early? I would say I think we're going to get a hit within 3 ticks here of the target. So I think you could try a 1.1098 bid with a 10 tick stop loss maybe, or 12 tick. And I tend to want to do it with 2 contracts because you got the possibility here of hitting a home run, and you don't want to be in a position where you've only got 1 contract and you just simply have to tie it to a stop loss. So I think I'm giving you enough to go on here. A few more questions. We'll keep on going. Armistead. Oh, great question from Armistead. Good. Can you go over the macro key? No. Let me do that after this lesson because it's so specific to your needs that I don't want to put this recording out as something for everybody. So when we've concluded the session, I will show you a little bit of what's going on there with TradeStation. But in the meantime, surely there must be one question you have about something, anything, any trading vehicle. But all right, so we've looked at 2 things though that do have tradable consequences, and I hesitate to drum roll them by way of Twitter, but I'm hoping that both of these things are usable to both of you guys in a way that will pay the cost of the course, and also put you on track really for thinking this stuff really works, and I'm off to a good start. Armistead's question: do you treat the opening minutes of the ES differently? Not really, and for that reason, those opening minutes can be very useful because typically when the bell rings, you've got a little pandemonium to play out in the first minutes of the day. And you saw in that one chart that I showed you where something or other had made a bottom, rallied, and come back to test the bottom. And although there was this flux of price bars that we were looking at that represents fear and panic and greed and uncertainty, when we got down to our level, to sort of seeing those ups and downs of panic, fear, and hysteria in terms of their impulsiveness, we found a beautiful trade to get on board to power us out of the hole. So I would strongly encourage you to come to your trading desk with the stuff that you have learned. It's really going to be probably the quickest way for you to see how this stuff really does work. And it's a very strong point of emphasis for me that it is in times of great uncertainty and fear and greed and hysteria that hidden pivot analysis, that looking at all of the price action in terms of impulse legs, will be most valuable to you. So Armistead, I'm depending on you and you too, Suresh, for being the guys who regale the chat room with tales about how if you're really on top of the minutia of the first 5 minutes, you're going to make money. So and Armistead, you mentioned the that you feel that's what you need to overcome. There is a psychological hurdle for each of us. I've had it myself, and I still deal with it from time to time because, each time you embark on a trading career and you get smacked down, it takes a chunk out of your confidence. And trading successfully is mainly a matter of mastering your demons, because your demons are really represented there in the price action of whatever you're looking at. It's everybody facing down their demons. They're being influenced by price action to be scared to death or to doubt themselves. If it were otherwise, everybody would trade and everybody would make plenty of money. So the price action, it's an analog for all of the fear and greed and lack of confidence of all the people who are trading something at a given instant. So by its very nature, you'll see that the best trades come in times where the price action it makes you most uncertain, makes you least confident. So the best trading opportunities will never come out of the comfort zone. They'll come in places where most traders are really uncomfortable. So I've given you a way to discover ways of making use of those discomfort zones in a way that brings you to the trade with a bit more confidence than you might otherwise have. And the most important thing that I've learned in terms of the psychology of trading is that, and I don't even practice what I preach quite enough, because you can see that I am obsessively concerned with risk. I see so many trades where I could have, should have made a zillion dollars, and here I am telling my subscribers we don't want to risk more than 37 cents on this trade. But in this case here, I'm so sure of a turn from somewhere near 1.1095 that I should really just buy it a little higher than that, and I should dispense with the trading stops and just come back in 2 days. I can't trade that way. But basically, if you trade in a very risk-conscious way, and you do it almost as obsessively as I do, eventually you'll come to the point of realizing, hell, I'm making money on 5 out of every 7 trades, or even 3 out of 7, and you're still going to be a winner using the risk-reward relationship that we do. So if you just trade a little fearfully, but in small size initially, you're going to come to possess that absolutely vital piece of confidence. And that is, yeah, I'm going to lose now and then, but I'm winning most of the time. And when you are thoroughly convinced of that, when you really understand that on balance, I'm just going to make money. It's happening. I'm losing now and then, but on average, most of my trades are making much more than I'm losing. When you get to that point, you're going to want to step up the size, and that really defines a true trader. A true trader is someone who constantly gets bigger and bigger and bigger because he knows that the little things work. So that's what I would tell you relative to the psychology of trading. And just to kind of wrap things up, I want to tell you, first of all, that it is my great pleasure to teach this course, because for so many students, it's finally getting to something that absolutely works. And you probably guessed already that I'm really dedicated to teaching people what they need to know. The Rick Picks is really not to give people fish, but it's to give them rods and reels, and that's what I like to do. And I'm absolutely committed to bringing you and all other students as far along the learning curve as I can take you. So if you have the diligence and patience to be better at it than I, and believe me, there are a lot of people who have taken the course who are better traders than I. They're just, let's say, they run a little looser. Their instincts are better, whatever. They're better. And I think you can get there as well, but I'll take you as far along as the questions that you ask. And we can continue this in the form of No Trader Left Behind sessions, in the Wednesday sessions. Also, just for the first couple weeks here, If you have any charts that you want me to look at and evaluate, I'd be happy to do that. I'll do it for a little while. If I gave everybody the open opportunity to do that, it would add to the 400 emails that I'm already getting each day. But just for a couple weeks, feel free to beat me with any charts that you want me to look at, evaluate, and tell you what you might have been doing right or wrong. So with that, I'm going to wrap up this session. We'll have a Q&A after this, but I want to say that it's been a real pleasure teaching you. This was a small class, but that doesn't matter to me. I teach it the same way if they're 50 students or if they're 2. So I hope that you hit the ground running. You're going to find that when you come to your trading desk tomorrow morning, you're going to see the market with a new pair of eyes. You're just going to see things that you didn't see before, and many more of them opportunities. So I am going to pause the recorder here.